So, if you're an accounting student, you know it can feel like you're just drowning in a sea of rules and standards. But what if I told you there's a master key, a kind of GPS that guides every single one of those standards? Well, that's the IASB's Conceptual Framework, and today we're going to use it to map out the entire world of financial reporting.
So let me ask you a question. When you sit down to prepare a set of accounts, what's the one thing that really holds it all together? What's the fundamental bedrock that everything else is built on?
Now, you might be thinking of a specific IFRS standard, something you can look up in a book. But the real answer isn't a single rule at all. It's actually a network of really powerful ideas. It's a coherent set of concepts that define what financial reporting is trying to achieve. And that is the conceptual framework.
Okay, let's dive into this thing. We're going to break it down step by step. We'll start with the why, the whole purpose of reporting. Then we'll get into the who it's for, the how to make good data, the what, as in what are the building blocks, and finally, the rules. By the end, you'll see how it all clicks together perfectly.
First up, the why. I want you to think of the framework as the ultimate guide, that GPS for accountants. It's not really for your day-to-day transactions that are already covered by a standard. No, this is for the new stuff, the complex situations, the things no one's really thought of yet. When a specific rule doesn't exist, the framework gives you the principles to find the right path. It's what sets the true north for all of accounting.
So, why is this so important? Well, the big word here is consistency. The framework is the blueprint the IASB uses, so all its standards are logical and actually connect with each other. It's what helps accountants, people like you, develop policies so that a company in Japan is speaking the same financial language as one in Germany. And honestly, it's the safety net for those really tricky situations where the rulebook is just silent.
All right, let's move on to Section 2. We've got this amazing guide, but who are we guiding it for? Who are we creating these financial reports for in the first place?
The framework is laser-focused on this, super specific. While sure, lots of people might glance at financial reports, they are built for three primary groups: investors, both current and potential ones, lenders, and other creditors. And why them? Well, it's pretty simple. They're the ones providing the cash and taking a direct financial risk in the business.
And what are they trying to figure out with this info? They're making huge decisions. They need to figure out if a company can generate cash in the future. They need to evaluate how well the management team has protected their investment. Ultimately, our reports have to help them answer that one critical question. Is this a safe and profitable place to put my money?
Now for Section 3, the how. See, it's not enough to just dump a bunch of data on people. For that data to be genuinely useful for making those big decisions, it has to have certain qualities. So let's look at what makes financial information not just good, but great. Okay, before anything else, the framework says that all useful information, and I mean all of it, has to pass two fundamental tests. These are the absolute non-negotiables. If you don't have these two qualities, you basically have useless information.
And here they are: relevance and faithful representation. Information is relevant if it can actually make a difference in someone's decision. It helps you predict the future or confirm something from the past. And it's a faithful representation if it's complete, neutral, and reflects the true economic reality of what happened. Think of it this way. Irrelevant info, no matter how accurate, is just noise. And relevant info that's misleading, well, that's just dangerous. You absolutely have to have both.
Okay, so once our information passes those two fundamental tests, we can take it from just being good to being truly great. And we do that by applying 4 enhancing characteristics. We make it comparable, so you can line it up against other companies. We make it verifiable, so other people can look at it and reach the same conclusion. We make sure it's timely enough to actually influence decisions. And of course, we make it understandable. These are like the finishing touches that really maximize how useful the information is.
On to Section 4. So we know the why, the who, and the how. Now for the what. What are the actual building blocks we use to construct financial statements? This is the core vocabulary of accounting, right here.
The framework keeps it simple and organizes everything into just 2 categories. To describe a company's financial position, like a snapshot in time, we use 3 elements: assets, liabilities, and equity. To measure its performance over a period of time, we use 2: income and expenses. That's it. Every single complex transaction you can think of boils down to these 5 elements.
Let's break these down a bit. An asset, it's not just something you own. The definition is way more precise. It's a resource you control because of something that happened in the past and you expect a future economic benefit from it. Control, past event, future benefit. You need all 3.
And you see a similar logic with a liability. It's more than just a debt. It's a present obligation that came from a past event, and you know that settling it is going to require an outflow of your resources. The logic runs perfectly parallel to the definition of an asset. And this is where it all just clicks together. This beautifully illustrates what equity really is. It isn't some abstract idea, it's simply what's left over. It's the residual interest in the assets after you've taken away all the liabilities. It's the mathematical result of the other two.
Now for performance. Income. This covers both revenue from your normal business and other gains. The key thing to remember here is that it's an increase in your economic benefits that boosts equity, but, and this is so critical, it excludes any new cash that the owners put into the business themselves.
And as you'd probably expect, expenses are the exact mirror image. They are decreases in economic benefits that reduce equity. And just like with income, we make sure to exclude any transactions with the owners, like paying out dividends.
Okay, final section. We have our elements, we know what they are, but when do we actually put them on the balance sheet or income statement? And for how much? This is where recognition and measurement come into play.
So how do we decide when to officially record something? The framework gives us this clear three-part test. First, obviously, the item has to meet the definition of one of those 5 elements. Second, it has to be probable, not just possible, but probable that the future economic benefits will actually flow. And third, you have to be able to measure its cost or value reliably. If you can't tick all 3 of those boxes, it has to stay off the books.
And this quote from the framework itself just nails it. Recognition is the official act. It's the process, the moment an economic event gets formally incorporated and becomes part of the accounting record. And once we decide to recognize an item, we got to put a number on it. This is measurement. The framework lays out several different ways you could do this, from the simple historical cost to more complex methods like present value. The key thing to remember is the framework gives you the menu of options, but it's the specific IFRS standards that tell you exactly which measurement to use for which item.
So there you have it. We've gone from the highest level purpose of accounting all the way down to the nitty-gritty rules for recording a single item. The framework isn't just some abstract concept for a textbook. It's a practical tool. It gives you the principles, the why behind all the rules. So the real question is, how are you going to use this GPS to navigate the complexities of business and tell a financial story that is true, fair, and above all, useful?